Good evening. Tonight, we're diving into a topic that affects every corner of the globe. Whether you're a business owner, a traveler, or simply someone buying groceries, the US dollar and its powerful influence on the world stage. The US dollar is more than just America's currency. It's the world's reserve currency, the backbone of global trade and finance. Over 60% of all foreign bank reserves are held in dollars, and most international transactions, from massive corporate deals to everyday imports, are settled in dollars. When countries buy oil, or when companies trade goods and services across continents, prices are almost always set in dollars. This means the dollar's value directly shapes the cost of energy, food, and technology worldwide. Even small shifts in the dollar's value can send ripples across the globe, impacting economies, businesses, and families everywhere. A stronger or weaker dollar can change the price of everyday goods, influence job markets, and affect how much you pay for imported products. For travelers and students abroad, the dollar's strength can make vacations more affordable or more expensive, and it can stretch or shrink budgets for those studying or working overseas. A strong dollar makes U.S. exports pricier for foreign buyers, which can slow down American manufacturing and hurt jobs. At the same time, it makes imports cheaper for U.S. consumers, lowering prices on everything from electronics to clothing. When the dollar weakens, the opposite happens. Exports become more competitive, but imports cost more. Many nations, especially developing countries, borrow money in dollars. When the dollar strengthens, their debt payments become more expensive, straining government budgets and sometimes leading to financial crises. That's why central banks and financial leaders worldwide keep a close eye on the dollar. Its movements serve as a global economic barometer, signaling shifts in growth, inflation, and investment flows. As we enter this pivotal week in December 2025, the dollar is showing signs of weakness. This is largely driven by recent U.S. Federal Reserve policy decisions, as well as broader global economic shifts, including changes in trade, inflation, and interest rates. These changes don't just matter to governments and big corporations, they affect small businesses, families, and investors everywhere. Understanding what's happening with the dollar helps us all make smarter decisions, whether we're planning a trip, running a business, or saving for the future. Grasping these moves is key to understanding the bigger economic picture and how it might impact your daily life. So, let's break down what's happening, what to expect from the euro and pound, and why this week could set the financial tone for months ahead, not just for Wall Street, but for all of us. The US dollar is starting the week on a soft note. Its value is slipping against other major currencies, and this trend is catching the attention of investors and analysts worldwide. The greenback, once seen as an unshakable pillar of global finance, is now facing a period of uncertainty and vulnerability. Its value is slipping against other major currencies, including the euro, the yen, and the British pound. This isn't a sudden drop, but rather part of a broader trend that's been building for months as investors anticipate changes in U.S. monetary policy. This isn't sudden, it's part of a trend as investors anticipate lower U.S. interest rates. The prospect of the Federal Reserve cutting rates has been looming for some time, and markets are now reacting to the growing likelihood that these cuts will happen sooner rather than later. For years, higher U.S. rates attracted global money, keeping the dollar strong. Investors from around the world flocked to U.S. assets, seeking better returns and the safety of the dollar. This demand propped up the currency and made it the go-to choice for international trade and investment. Now, the Federal Reserve is signaling possible rate cuts, making dollars less appealing. When interest rates fall, the returns on dollar-denominated assets decrease, prompting investors to look elsewhere for higher yields. This shift in sentiment is a key reason behind the dollar's current weakness. Meanwhile, other economies are showing resilience, and their central banks may soon raise rates. The European Central Bank and the Bank of England, for example, are hinting at tightening policy, which could make their currencies more attractive compared to the dollar. This shift reduces the dollar's relative appeal. As global investors rebalance their portfolios, they're increasingly favoring currencies backed by stronger economic outlooks and higher interest rates. A recent example, when New Zealand's central bank pushed back on rate hikes, its currency dropped, showing how sensitive markets are to central bank signals. This kind of reaction isn't unique to New Zealand, it's a pattern seen across global markets where even a hint of policy change can trigger sharp moves in currency values. As the Fed hints at cuts, the dollar weakens. The market is quick to price in expectations, and the dollar's decline reflects a broader shift in investor confidence and strategy. The dollar index, DXY, is expected to stay low as traders await key economic data and policy meetings this week. The DXY, which measures the dollar against a basket of major currencies, is a crucial barometer for global investors, and its recent performance suggests caution and uncertainty. The dollar isn't crashing, but it's consolidating, waiting for the next big move. This period of sideways movement reflects a market in limbo, with traders hesitant to make bold bets until more information becomes available. This week's economic reports and central bank meetings in the US and investors are watching for any signs of policy shifts, economic surprises, or unexpected announcements that could tip the balance in favor of the dollar or its rivals. The stakes are high for global markets. Currency moves can ripple through stock markets, commodities, and even the prices of everyday goods, affecting economies and individuals alike. All eyes are on what happens next. As the world waits for the next signal from central banks and economic data, the dollar's path remains uncertain, and the coming days could set the tone for the rest of the year. The Federal Reserve stands at the very center of the financial world, shaping the direction of the US dollar and, by extension, influencing economies across the globe. Its decisions ripple through markets, affecting everything from the price of groceries to the value of investments and the strength of international currencies. The dollar's current behavior is a direct reflection of the Fed's policies and the expectations surrounding its next moves. When the Fed acts, the world listens and reacts. The Fed operates under a dual mandate: to keep inflation under control and to maximize employment. It pursues these goals primarily by adjusting interest rates, a powerful tool that can either stimulate economic growth or cool down an overheating economy. In recent years, the Fed raised rates aggressively to combat surging inflation. Now, with inflation showing signs of easing, the central bank is signaling a possible shift, hinting that rate cuts could be on the horizon. Recent comments from Fed officials have been interpreted as dovish, meaning they appear more willing to lower rates to support continued economic growth, even if inflation hasn't fully returned to target levels. This shift in tone has led investors to anticipate a rate cut as early as March. As a result, the dollar has come under pressure, since lower interest rates typically make dollar-denominated assets less attractive to global investors. When US rates fall, returns on dollar investments decline, prompting investors to seek better opportunities elsewhere, sometimes in emerging markets or other major economies. This week, all eyes are on speeches from Fed leaders. Every word, every nuance, will be scrutinized by markets for hints about the timing and size of future rate moves. The Fed faces a delicate balancing act. If it signals too much willingness to cut rates, inflation could flare up again. But if it remains too cautious, economic growth could falter, risking higher unemployment. That's why every economic report this week, on jobs, prices, and growth, takes on added significance. Each data point could tip the scales in the Fed's decision-making process. The central bank's next move will depend on the latest readings from the economy. Strong job growth or stubborn inflation could delay cuts, while signs of slowing growth might accelerate them. As the world watches, the Fed's choices will shape not just the dollar, but the global economic outlook for months to come. This week's economic reports will shape the Fed's next steps and the dollar's direction. Tomorrow's non-farm payrolls report is the world's most watched jobs indicator. Analysts expect only 50,000 new jobs and a higher unemployment rate, signs of a cooling economy. A weaker report could push the Fed toward rate cuts and send the dollar lower. Thursday brings the Consumer Price Index, the key inflation measure. If inflation is higher than expected, the Fed may hesitate to cut rates, boosting the dollar. Lower inflation would reinforce the case for cuts and keep the dollar weak. The combination of jobs and inflation data makes this a make-or-break week. Markets are on edge, waiting for surprises. The outcome will set the tone for months ahead. The stakes couldn't be higher. Europe is in the spotlight too, with the euro's fate hinging on US data and a key European Central Bank, ECB, meeting. The ECB faces sluggish growth and inflation challenges. If the ECB signals confidence and upgrades forecasts, the euro could strengthen. But if President Lagarde pushes back on rate hikes, the euro may lose ground. EU Council meetings and fresh economic data add to the uncertainty. This week is pivotal for the euro's direction. The British pound is under pressure after weak economic data and faces a crucial week. The Bank of England's Thursday meeting is the main event. Markets expect a rate cut. Lower rates make the pound less attractive, fueling its recent decline. Key jobs and inflation data will influence the bank's decision. If wage growth slows and inflation falls, the case for cuts strengthens. But stubborn core inflation creates uncertainty. Many investors are betting against the pound, making the risk of a sudden rally high if there's a positive surprise. A short squeeze could send the pound sharply higher. The pound's fate hangs in the balance. Central and Eastern European currencies, the Polish zloty, Hungarian forint, and Czech koruna, face unique pressures. Falling inflation and potential rate cuts make these currencies less attractive. Poland's inflation data and Hungary's central bank meeting could signal future cuts, weighing on their currencies. The Czech central bank is also in focus, with new government policies and energy subsidies influencing inflation and rate decisions. Domestic politics and central bank moves are shaping each currency's path. It's a crossroads moment for the region. Currency moves affect everyday life. A weak dollar makes imports, like electronics, cars, and food, more expensive. For U.S. exporters, a weaker dollar boosts competitiveness abroad. Travel costs rise when the dollar is weak, but the U.S. becomes more attractive to foreign tourists. Currency swings also impact investments. International stocks can gain or lose value as exchange rates shift. These changes ripple through family budgets, business profits, and retirement savings. Understanding currency markets isn't just for Wall Street, it matters to everyone. The effects are real, immediate, and personal. The global currency story touches us all. As the week ends, the world's financial system is in a delicate balance. The Fed, ECB, and Bank of England are all making critical decisions. U.S. jobs and inflation data will guide the Fed's next move. The ECB must balance slow growth and stubborn inflation. The Bank of England faces a pivotal rate decision amid heavy market bets. Central banks in Poland, Hungary, and the Czech Republic are navigating their own challenges. These events are deeply interconnected. A weak U.S. jobs report could boost the euro, while a hawkish ECB could strengthen the dollar. The biggest market moves will come if reality defies expectations. The outcome will shape global markets, travel, and investments into 2026. Surprises could trigger sharp reversals. The world is watching. This is a week of high stakes.